Brilliant. Thank you very much. So, morning all, and welcome to this Informa event. We are looking at when equity release is suitable. So, just want to, technical glitch already. There we go. Brilliant. So I just want to welcome you all. Thank you for finding the time to come and join us. Today's event, as our last event was, will be recorded, and we will be publishing this on our professional connections page on our website as well. And, you know, you can never get rid of us. We'll be sending a follow-on email at the end of this event as well with the link to the video. So you can obviously watch it again if you're really keen to do so, but also share that with colleagues you have at work or friends and family, even going that far. So we're joined today with Zoe Hatcliffe from Springtide Capital. Zoe will introduce herself a bit more later on in the slides, but she's going to be very much leading the presentation on mortgage and equity release. She is a mortgage and equity release consultant for Springtide Capital. Now, the main aim of these webinars is always to be very informative and to stick to our hour schedule. So we'll aim to finish up by 11:30, and we'll be taking your questions throughout the event, and maybe have a Q&A at the end as well. Like with all things with these kind of webinar Zoom meetings, I'm currently hotspotting off of my mobile phone. So I have got other advisors on the call ready to step in, as well as Marina as well. So if we have any technical glitches, and Zoe, quite funnily enough, said she's got the tree surgeon in next door. So if you suddenly hear some loud soaring noise, she might be suddenly putting on her headset. Well, the world we now live in with Zoom meetings. So with questions, we've got here. Hang on a minute, there we go. So we've got the question and answers. So by all means, please click, if you have any questions throughout the presentation, don't wait until the end. Click on the Q&A button to open up the window, type your question into the text field, and then if you wish to remain anonymous, please check that box before sending. As we get these questions throughout, I'll try to ask Zoe as we go through. And as always, if there's any questions we don't get to, or we don't have the answers to straight away, we'll follow up with an email afterwards as well. And before I get started, I just want to say thanks again to Earthly Kind, who we use to source our gifts, or maybe our bribery to get you onto these calls. The prizes, well, not prizes, sorry, the gifts this month was tea, coffee, and chocolate. So hopefully you've all enjoyed those. Earthly Kind is a great company, and obviously they source us these products which are plastic-free, plant-based, fully recyclable, and ethical. So, you know, as we're sending these out to, you know, multiple people throughout the months, it's nice to know that we're not damaging the earth with the product as well. And July, I wasn't aware of this, and probably this is what it's all about, to make us more aware. July is a plastic-free month as well, so we've certainly achieved that with those boxes. So moving on, I just want to cover off this area of the advice. So Herbert and Webster, the advisors here, Rob Gray, Kurt McSweeney, and Ian Brooks, they are CFA qualified. That's a qualification which allows us to provide advice on later life and care products. And most recently, actually, Ian has achieved SOLA accreditation, and SOLA is the Society of Later Life Advisors. It's been a great achievement there by Ian, because he only joined the firm last November, and this was one of his priorities to get this qualification or accreditation for himself, and also it's a great accreditation to have in line with the firm as well. Now, a lot of later life care planning with clients sometimes involves looking at care funding needs, and an option of that is looking at usually sometimes the largest asset the client may hold, which is a property. And that kind of advice would lead down to the route of mortgage lending or equity release. Us as a firm, we don't provide, we are not mortgage advisors or consultants in that area of field. We don't transact on that business. So we very much look to kind of reach out to third parties like Zoe Hatcliffe to help us provide that area of the advice and bring a kind of holistic approach. You're going to find out through this presentation that the industry relating to equity release, lifetime mortgages, has changed massively. Massively since the 90s, which I think we're all aware of, some of the horror stories back then, the panorama shows, and a very, I think, can be still a bit of a taboo subject with people if you mention the term equity release. that industry, which Zoe will cover off, has changed massively. But even over the years, we've been working with Zoe and we've helped clients look at equity release, lifetime mortgages. The products themselves over the last 3 years have changed quite drastically as well. Again, becoming more and more kind of client friendly, which Zoe will cover. So it's great to have that area of expertise, that advice, because I'd say, especially this area of the market, is something that you don't really want to dip in and out of. You need someone who is constantly on the front foot with this industry. So we very much look to work with Zoe. We've worked with Zoe over a number of years and built up a really trusted relationship. And my hope from this meeting is this is going to be a kind of great example of how this area of advice works, but also give you a great contact and someone who you can approach if you have questions where you may be acting for attorneys for clients and things along those lines. So further ado, let's move on to this slide. Now, I'm going to be doing the slide movements for Zoe, and as I've said, Zoe is a mortgage and equity release consultant. She's going to start to give us a bit of a brief overview of Springtide Capital and her area of the business, and we'll start to go through these slides together. As you probably all know, and I'm sure Zoe was about to talk just then, but I can never be quiet for more than 5 minutes, so I'll chip in throughout and I'll be bringing the questions forward to Zoe as we go through. So Zoe, hopefully that's a good introduction for you to chip in, and I will now be quiet.
Lovely, thank you, Adam, and thanks to you and your team for the snacks. I've already dug into the team, so thank you very much. Yes, well, welcome everyone. I just initially wanted to give you a little bit of background about Springtide Capital and how we came about. Our managing director, Henry Knight, formed Springtide back in 2005. Our office is based in Knightsbridge, but we do cover all of the southwest, the southeast, and to be honest, nationwide now. What we've seen over the last 18 months with regards to Zoom and all of the access that we can now reach out to all our clients. As it is in our industry, you know, I come across brokers that I worked with 20 odd years ago, and it was really important for Henry to pull together a wealth of knowledge and experience when he started setting up and growing Springtide Capital. And when I joined back in 2016, one of the things that impressed me, although I'd known Henry for a number of years, you know, they were one of the first brokers that a lender like HSBC was going to do their trial with the intermediary market. So it was a huge honour for someone like Springtide Capital to be accepted by HSBC. So that's the type of brokerage that I wanted to join, certainly, and also to work with Henry. A bit about me. Yeah, I joined Springtide Capital in 2016, but I have actually advised in the equity release market for over 10 years now, and have been a mortgage broker for over 20 years. Prior to that, I was in the intermediate financial advisory market as well. But I think, as Adam's already pointed out, you know, it's such a huge area of advice that you then want to specialise in one area. So that's one of the reasons why Adam and Herbert and Webster do not advise in mortgages. So Henry was very keen because he could see that the later life lending market was expanding and recognised that he didn't have that offering within the company. So I was brought in so that we could offer a full spectrum of mortgage solutions, and also that we had the later life specialists on board. Like Ian and the rest of the guys, to actually advise an equity release, you have to have a specialised equity release qualification. So not all of our advisors are qualified in that area. It's only me that heads it up and one other at the moment. So later life lending. Next slide, please, Adam.
Excellent.
Okay, so borrowing in later life. I've touched on this already. So this market, the later life lending market, is the fastest growing sector across the board. And that's not just in equity release and lifetime mortgages. I'm not going to just talk about that today, but actually what I think everyone has realised in the industry and clients themselves is that there is still a need for borrowing, whether you reach to retirement or beyond. None more so ever that there is a need, whether that be on a lifetime mortgage basis, or whether that you've still got an existing mortgage and you need to continue that borrowing. I think gone are the days where a mortgage was 25 years and then you'd fully repay it off. I think the products choices that we've had over many years now available have also created this need of later life lending. So as an industry, we see it in 4 areas. We see economic. So I think we can all agree debt doesn't go away just because you're in retirement or have retired. Mortgages tend to come to term around your sort of mid-60s. Typically, last date is normally where age 70. So what choices do you have? And especially when you have an interest-only mortgage where you are typically, yeah, I'm always going to sell up and downsize, where in reality, one typically isn't ready to do that. Lack of savings. I know obviously Adam sees this more than I do, but you know there is a common thread. I don't think we all as a generation or we save as much as we should. So really the economic side is the first and foremost with where we see later life lending fitting. Lifestyle, yeah, people want to maintain their lifestyle in retirement. It is one of these things that when I speak to clients, is that why should I not be able to do everything that I've worked so hard for? Why can't I go and see my children in Australia? I want to be able to afford that that level of lifestyle. Sometimes it's not even a wealthy lifestyle. It is just to be able to pay for their essential expenditure, to be able to make sure that they can, if they need a new boiler, that they can have the money available to be able to do that. Baby boomers, I wonder when we're going to stop saying the word baby boomers. I know that terminology has been around for many, many years. But yeah, we all know about the baby boomers. Everyone is rich in property, in bricks and mortar, but not typically, again, in savings and investments. And they see their children, none more so in recent years, bit struggling to get on the property ladder. I think this year we've seen some real restrictions over the pandemic, but we have seen some lenders realising that they've got to help the younger generation get on the housing ladder, but still a deposit is needed. The other thing that we've been really, we've seen an increase on are where people just want to see that they can pass on and help their children while they're basically alive. I had one client say to me many moons ago, she said, I really don't want to be 6 foot under to help my grandchildren. As much as she made me laugh, actually, we see more and more people where they actually want to be able to see the benefit of what they can do to help their children and family. Finally, longevity. Yep, we are all living longer, which is great. But again, I think being able to plan for typically the unknown, actually. I think some people are wanting to retire a little bit earlier, or at least step away and maybe semi-retire. And of course, that money's got to last for a lot longer. The good thing that I see within the market now is that more and more people realise how important it is to have that financial planning. Gone are the days where you just took your pension, you didn't seek an advisor, and you thought, yeah, that was the best thing. And I think more and more people realise how important full holistic advice is, and certainly to make sure that their income runs as long as possible. And the last thing, I think we've seen a dramatic change in actually people's priorities with regards to wanting care within the home. They don't want to sell up. They don't want to go into a care home. I think we've heard some horrific stories over the years, and unfortunately has given the care homes a really bad press. But I think with regards to how that market has improved with their service offering, I have many clients that now actually want to pay for their care but stay within their home. So that's where we see the sort of 4 areas. Adam, did you want to add anything there?
Well, I was just going to kind of promote you a bit more on this next slide as well. Those 4 areas is definitely where we see the need for our clients. You know, we have many clients who are approaching retirement or have just retired. And, you know, some of them are still very wealthy clients. They've got a lot of assets, but they've still got mortgages. As you say, the mortgages don't disappear at retirement. And, you know, very much they may have a mortgage term which is fixed to say 60, 65 when they are retiring. And they don't wish to kind of lose control of their capital to pay off the mortgage. And again, we have clients at the other spectrum where we are looking at later life. I know Kurt had a case recently where, you know, they wanted to stay in their home to provide care. Now, those 2 solutions, without me giving the advice and jumping on your bandwagon, Zoe, is completely 2 different types of mortgages. And this is where I think, this is why I very much like referring this kind of business over to you at Springtide Capital, because you're able to offer, as you say here on this slide, traditional mortgage routes, and also the retirement interest only mortgage and the lifetime mortgages. And for our viewers, they may be looking at that going, well, I thought that'd be the case with all mortgage advisors, but because the later life area and the equity release area is so specialized, you need to be qualified in that area. And my concerns is, what we're not trying to do for us as advisors when we're referring clients to you is saying, actually, this client does need a traditional mortgage. I'll send it to this type of mortgage advisor. Or this client needs an equity release mortgage. I'm going to send it to an equity release mortgage advisor. You cover all the spectrum. So what you're able to do with that client is actually sit down, understand, you know, what they're trying to achieve, and look at the best lending solution for them. And I think for me, without jumping over all your case notes you have, your case studies, is recently I had a client who, you know, had quite a large capital repayment mortgage. My gut feeling was, oh, he needs to go onto a lifetime mortgage. But you were actually able to secure him a traditional mortgage, which obviously was lower interest rates over an 8-year period. But the main thing was to move it over to an interest only from repayment. Now, it's not the best financial position to be in retirement still with a large mortgage, but for him as that client, moving it from a repayment mortgage to an interest only mortgage allowed him to retire. So hopefully that's come across to the viewers that, you know, for you, you can cover all those areas and, you know, really find the best solution for the client when it comes to the lending.
Yeah, absolutely. And I think this is really important to highlight. So this is why this Informa today isn't just about lifetime mortgages. It is about later life lending. And I've had many a scenario where I've had a client approach me going, I think I need a lifetime mortgage. That's what I've been told. And actually speaking to the client, getting to know the client, looking at what they need now, and maybe looking at, you know, future plans and requirements. Actually, we can defer that need of a lifetime mortgage, and I'll explain why we would potentially look at deferring that option. Because what we have been able to have access to is not all lenders. Some of the lenders are still looking to lend to a later life or to a later age, sorry. So if a client come to me at age 60, 62 and they wanted a lifetime mortgage, you know, it's my responsibility to make sure that we cover all the other options first. We look at traditional mortgages, we look at retirement interest only, and I will cover that in a little bit more detail. In fact, I'll do this now. So traditional mortgage, the mainstream banks, lenders that everyone is familiar with. You can have it on a capital repayment and interest only, subject to lenders' requirements. And with a traditional mortgage, it will come with a term. And also it will come with a monthly payment, your monthly mortgage commitment. Retirement interest only, not all lenders have entered into this market. There was a couple that entered into it because they could see a gap in the market. The main difference is it's still underwritten on income, so you still need an income, whether that is from pensions or whether that's from a portfolio, a mixture of both. Typically, there's no term. You can run the retirement interest only options without any term at all, or to a, I did one a little while ago for someone who was 72 and we did a 40-year term. You know, the likelihood is he's never going to let, but that's how they set them up. Pricing isn't as competitive as a traditional mortgage, but I think with all of these, it gives clients time and choice. And then I'll go into more detail in a little while about lifetime mortgage. So yeah, I absolutely agree with you, Adam. I've certainly had many a scenario where a client just assumes their only option is a lifetime mortgage, but because we're able to offer the whole spectrum of the lender options, then you know we are able to give alternative solutions as well.
Fantastic.
So, typical reasons for a lifetime lending. Some of these would be typically more on the lifetime mortgage option rather than a traditional mortgage. But what are clients' needs for? You know, what currently am I seeing typically, and also the guys at Herbert and Webster. But what are they seeing our clients' needs and requirements in this area? And we've already mentioned to repay an existing mortgage or unsecured debts if it's appropriate. Gifts to family, we've mentioned. Financial planning, such as IHT. I'm going to touch on this. Now, Adam's already made an introduction with regards to, in the 90s, we saw some horrendous schemes out there, and we've seen regulation really tighten up, and I wouldn't certainly be advising in this area if we didn't have the regulation that we have today. The Equity Release Council was formed many years ago. Initially it was called SHIP, but thankfully they changed that. You can imagine trying to explain that to an individual that may have been hard of hearing, but anyway, so the Equity Release Council was formed, and it outlines certain principles that lenders and advisors adhere to, and I'll touch on these in a little bit more as we go on to further slides, but one of those things is to make sure that a client is protected. I think one of the things that we are seeing more and more, the FCA are promoting it, and I'm sure in everyone's world, to all our viewers, is vulnerability. And we hold that very close within the core of our business. And actually, we are currently reviewing and updating our vulnerability policy. And I think one of the things that we find is just to make sure that if we are looking at financial planning for clients, and I've come across someone saying to me recently, I want to gift my son £100,000. He's had a really rough time over the pandemic. But when I actually sat and looked with her, looked at her position and everything, it would put her in a really vulnerable position to do that. So I contacted her financial advisor with her permission, and we had a discussion, and we just, we gave our advice and said at this stage we don't think that that's the right thing to do. And actually we spoke to the son, and he said, oh, I don't want mum's money. But she just felt at the time, she panicked. It was a knee-jerk reaction. I want to give my money away and help my son. So financial planning, I work very much with the financial advisors. We work in tandem because it's really important to make sure that it is the right thing for a client to do. Care costs within the home, I've already covered that. Getting this, coming across this a lot more, where people would prefer to stay in their home as long as possible. So how can they cover those fees and carry on with that funding? Help with day-to-day living expenses. Yeah, I've got a great case actually where a few years ago someone came up to me and approached me and said, look, I've got this situation, everyone's telling me to sell. I lost my husband a couple of years ago. We was always going to sell up and downsize. I've only got 50% of his pension. I've still got to cover all the household bills, but actually I love where I live. I've got the doctors down the road. I have a fantastic friends network. I really don't want to move, but I'm sitting here in £1 million property, and that's the biggest asset, and it's all tied up in bricks and mortar. So yeah, we can help with that. Supplement retirement income we've already touched on, and what most people actually don't realise is you can use certainly a lifetime mortgage to buy a new home. So I've very recently I've got clients that have just wanted to move, but not again want to put all of their asset back into bricks and mortar and save some of that capital back. So we've looked at a lifetime mortgage. I've got a client, we've looked at a traditional interest only mortgage. And I've also got a client that has raised a lifetime mortgage to purchase a second home down in Cornwall. So again, various reasons why we'd look at this level of or later life lending.
I must admit, the new home I always thought was a bit strange, because I thought, well, you've already got a house, why would you want another home? And Ian has had a client recently do exactly that. Quite a great value of a property in London, and actually wanted a second home as a holiday home near the coast. And again, she was a lady, you know, lived by herself, had no dependents, so she's a bit like, well, you know, why you know, I don't want to sell up, I just want to go and buy another house by the coast. And yeah, it's actually quite common. I didn't really realize how common that can be. I think you've already answered a couple of the questions which have come in as well, Zoe. Basically, is there any restrictions on what you can do with the money from any kind of lending facility? It sounds like, you know, as long as it's not illegal, then you're pretty much good to do anything with that money once it comes to you. Is that correct? Would you say it like that?
We do our due diligence. So typically we always invite, because ultimately, certainly on a lifetime mortgage, it will affect beneficiaries, whether that be children, etc. So ultimately we will make sure that we, if the clients want to, include any of their children, any of their advisors within in any meetings, or copy them into any correspondence. And there have been situations where it's not deemed suitable for the reason what they want to raise the money for. So yeah, typically, the lenders, some of the lenders will require an explanation of why they're raising the money, just to make sure that no one's being put under duress, and it is a satisfactory and plausible reason what they're doing.
And this is something which you may be planning to cover later, but I was quite surprised the other safeguard benefits this area of business has to do with the actual instructed solicitors, the surveyors. They have to be particularly qualified to do this area of advice. Is that correct?
Yeah, so most, obviously our viewers will know as well. So not when you look at putting, so we're concentrating more on the lifetime mortgage side here, because that requires an enhanced level of legal advice, and that would be a face-to-face meeting, and making sure that the clients are not under duress, and making sure that they're fully aware of what they're doing. Some solicitors don't want to advise or give advice in that area. Other solicitors will do. So yeah, I just make sure that the solicitor that we work with is fully aware of the sort of legal requirements when it comes to a lifetime mortgage.
Fantastic. Excellent. Well, we'll move on to the product development side, because this is what I think has been, just really gaining my experience working with you over the several years now, is this product development, and also how it's developed massively since the 90s, but it's even, really developed over the last 3 to 5 years as well. It's a real changing part of the market, really. I think the the main thing which I'm thinking about is the interest rates. I know we did some lending a couple of years ago, and I think, you know, a year later the interest rates were even lower. So yeah, I'll let you cover this area.
Yeah, well, just even, you know, I gave you a Best Buys yesterday, and you know, we're now seeing sort of traditional mortgages. You know, we've got 2-year fixed rates as low as 0.94. We've got 5-year fixed rates at 1.09 on the traditional side. So yeah, well, you know, I think since the crash 2007, 2008, you know, I've been saying for the last, well, I used to say the last 10 years, but already we're sort of 14 years on. But you know, yeah, you know, rates have never been as low as they have, and we're still saying that 14 years on. But you're right, we have seen lots of development, and they had to be fair, the lenders, you know, it's become a very competitive market across the board. But one thing I just want to, I remember someone saying to me about sort of age, and I think for too long as an industry we just put people of a certain age in a sector or in a aside that they were never going to want to go away. They weren't going to go and buy another property. You know, that they didn't understand that they're, you know, what they're going to need, or that they didn't want to help. I think we just didn't give clients of a certain age the choices, and I think lenders have realised that, and I think that certainly with the Equity Release Council and listening to the brokers and clients themselves, it's enough is enough. You need to step up and provide, you know, what we need. So fixed interest for life, Adam's already mentioned that. So one of the principles the Equity Release Council have set out is that the fixed interest is for the life of the mortgage. Believe it or not, some of the dreaded old schemes were variable. No one knew exactly how much the mortgage debt would grow to. So, and let me just cover off a little bit about what a lifetime mortgage is, because we've not really covered that. Typically, a lifetime mortgage is a mortgage that you never pay back until death, or if you need to vacate the property to go into long-term care. So that's the difference between care within the home and care. If you vacate the property, you need to then repay that lifetime mortgage back, and typically it's after 12 months. So the idea of a lifetime mortgage is the interest is compounded, which is why it affects beneficiaries of any estate. But having then the fixed interest for the life of the mortgage, it's so transparent, and that's what I go through with clients, is that you can see exactly how much that mortgage debt would have increased to over a 10, 20, 25-year period. So it's very transparent. And what I would say, when you know, this is how the market has changed. I was probably 10 years ago recommending 1 or 2 lifetime mortgages a year, certainly because of the way the pricing was, and they just didn't have the flexibility and products available. Now this is a big part of my business on a month-to-month basis, and when interest rates are sub 3%, where we were looking at a compounding mortgage 10 years ago, 10 years ago, doubling in sort of 8-10 years time, we're now looking at a mortgage debt doubling in 20+ years time, because of where the interest rates are.
Yeah, and this is where we've had a couple of clients where they've had existing lifetime mortgage, equity release mortgages, and those rates are 6-7%. They've had them for some time, and those clients are able to, as you can do on a traditional mortgage, they can look at remortgaging over to a new product with maybe a lot less interest, and therefore that could be an advantage to look at that area of advice as well.
Yeah, absolutely. Obviously, we take into consideration any early repayment charges and make sure that we're all putting the clients in the best possible position at all times. But yeah, absolutely. So we've seen where the clients are looking at now, you know, they might not want to take a lump sum on day one. They might want to have access to funds over a certain period, over a certain time. So we've seen where we've got lenders now that offer both an initial lump sum and also access to further cash, and they can take that at any time, typically minimum of £2,000. And I always advise my clients before they take any further monies from their drawdown is they make contact with me first, just so that we can do a sense check and make sure that their situation hasn't changed and it's the right thing that they do. I think one of the best things that we've seen is fixed early repayment charges, and the reason why I've got hands up is because some of the older schemes on the market, their early repayment charges were all based on the gilts and the movement in gilts. And if I've got a client who, potentially is in their 80s, that they've not worked in the finance market, it's really difficult to try and explain the impact of any early repayment charges that are linked to gilts. And it's been a thing in the industry that we just need to make this a lot more simpler for clients. So lenders have bought, thankfully, fixed early repayment charges. Typically, a lifetime mortgage should have been needed to be paid back if the original requirement, you don't look at it as a short-term lending option, but client situations change. So fixed early repayment charges was certainly a big tick in the market. Inheritance guarantee, downside protection. Yeah, there are clients that just want to make sure that they can still leave their children an amount, but that obviously would affect what they can access as well. But that was a good innovation that they were bringing out. And also downsizing protection. We don't know when we're going to want to move, so most of the lenders, depends on their schemes, offer a downsizing protection so that you know that you can port the mortgage to a property if required. Okay. No negative equity guarantee. I'll touch on this because this is one of the big things that happened. People were having, the knock on the door by the big burly man asking them to vacate their home because their equity release mortgage had then become worth, or the debt was worth more than the house or the value of the home. That is all out the window now. You stay in your property. The lender can't go over the remaining of your estate. There is just no negative equity, so you can remain in your home until death.
Okay, so just so for the viewers there, Zoe, so far the benefits of this is very much the interest rate is fixed for the life of the mortgage, and obviously lifetime is until the day you die, so the interest rate is fixed throughout that whole time. You've then got obviously the no and negative equity guarantee. So very much that means then to understand that position is if the debt ever got greater than the property value, they'll never obviously kick you out of the house. But also when that person has passed away, the lender can only ever get the full value of the property. They can't go past the value of the property and grab other assets to cover off the debt. Is that what you're saying there?
Absolutely. All other, they're just taking the charge over the property itself. Yeah. Brilliant. And they have no other access to any other estates, pensions, or anything like that. So that was really important to see that come on board. I won't go. There's just a couple I want to touch on here. I think one of the most impressive things we've seen over the last 5 years is the 3-year window for no early repayment charges. Now, I have mentioned lifetime mortgage isn't seen as a short-term finance option. And we look at, and when we're talking to clients, we try to consider all of the possibilities that may happen. And on the first death, a widow or a widower, they're just not in a position to make decisions, quick decisions. What do they want to do? So what the lenders have allowed is that whether you've got fixed early repayment charges or early repayment charges that are linked to gilts, what they've said is, look, we're going to give you a 3-year window so that within that time, if you decide that you can't carry on living in the home, you know, that was your together home, and you want to move near a family, and you want to repay the mortgage off in full because it's not needed anywhere, we will not charge you an early repayment charge. And that, I think, out of all of the developments that we've seen, it certainly is the top for me.
And when did that development come in? Is that quite recent then to the industry?
So the first lenders typically sort of, we started seeing it filter through, and what you'll see is if one lender does it, the others will follow, depending on you know, their own constraints. But yeah, we started seeing that come in about 5 years ago.
Brilliant. And we've had a couple of questions come in, and I think you've answered most of them. There's one question coming in. I don't know if you'll be able to answer this, but how much money can you typically release against the property? Is there a kind of you know, ball figure to know when kind of considering this option for clients?
Okay, so if we're just looking at the lifetime mortgage option, which is where there's no underwriting on income. The underwriting is purely based on property value and your age. You're typically looking at maximum around the 50% mark.
Okay.
And it's based on, so the younger you are, actually, and the higher the younger you are and the higher the loan to value, the more expensive it will be. The older that you are, the interest rates can get obviously a lot cheaper. So my average loan to value, I did an exercise, I was speaking to Henry, my MD, the other day, and we looked at sort of average loan to values, and it was around about the 35%, taking into consideration some of the drawdown facilities.
Okay, brilliant. So with that then, so this is obviously and correct me if I'm wrong, this is looking more at the lifetime mortgage, where obviously they're not looking at income, they're looking at the pure value of the property. Really, you know, the older you are, in theory, potentially the more you can borrow against the value of the house, because you won't be around for as long, and sometimes even the interest rate can be lower as well, which is very good. I thought it might have been the other way around. And that product, this is everything what we've been talking about: fixed interest rate for life, you know, kind of a 3-year window on first death of the spouse to give people time to kind of reconsider their options. There's a 10% overpayment facility. I don't know if that'd be on all products, but I know a number of my clients have taken that option on because they want to kind of still continue to service the debt. But the big thing about this is there isn't a requirement to make that payment. It's a facility they can decide to use if and not, you know, looking at each year, depending on what else is happening in their financial position, basically. So yeah, it's a very, very flexible product.
It is, and what's really important with the overpayment facility is there's no affordability checks.
Yes.
So if a client hasn't got the income or the affordability as perceived in a lender's criteria, but they do have access to capital sums, or they've been, you know, they've come into money and they want to make an overpayment, then absolutely. They've got that flexibility, which is across, I'd say, 90% of the schemes available now. I just wanted to just finish off on the vulnerable client part as well.
Yeah.
I have mentioned about lenders will, some lenders will ask what the money's for. They never used to, actually. You know, they just said, "Oh, right, okay, you want £100,000," and signed it off if the property was acceptable. So we are seeing lenders now making sure that, you know, we've all done our due diligence, we are covering our clients, and we are putting our clients' needs first, and we're making sure that we're treating vulnerable clients in the most appropriate and responsible way. So, but that's not just us advisors, we're seeing lenders do that as well.
Brilliant. And I've got another question coming through. I think it answers it. But you know, the 3-year window for no early repayment charges following the first death, if that person remaining in the house wanted to downsize at that point, in theory, they potentially could do that. They could then move from the kind of existing home to a new home. That obviously the value of the new home in theory would be of a lesser value, and then obviously you could then decide to repay some of the capital. Basically, can you transfer the loan onto the new property?
Yes, you can, and you may decide, and that way you'd probably look at taking advantage of the downsizing protection. So you can move the property, adjust the loan to the new loan to value. You may need to take a partial overpayment. So that could be an option, or that you decide, actually, I've got £1 million property here, or I've got 100,000 lifetime mortgage, but I only want to buy 500. My new property is only going to be 500,000, so I actually want to pay my lifetime mortgage in full. I actually don't need it. So yes, absolutely, it's very flexible. So in that scenario, you certainly could exercise the downsizing protection option, or certainly just repay in full.
Fantastic. So
the downsizing sorry, I just wanted to a couple of things just mentioned there. The downsizing protection, some of the lenders have a 5-year window, or that it can happen at any time. So it would be product on plan specific. But again, that's where we look at talking to our clients and looking at, are you in your forever home, or can you see yourself moving in 5-10 years time? How realistic is it that you remain in your current home?
Okay, brilliant. And obviously, I'm just mindful of time. We're just 17 minutes past the hour, and I know we've got 2 case studies to go through. The main thing why I'd like to get across to our viewers here is you, Zoe, you as an advisor, because I know I won't pick on them, but I will do a little bit. I know there's the adverts of, you know, the equity release guy, you know, everyone's singing a jolly old song and going around the house to sign up the new lend, and everyone's really happy about the new lending facility. For me, you know, that isn't the actual case usually when we're looking at these kind of clients. And I know we've got one case study which is kind of rebrokering a existing loan, and the other one I'd say I'd really like to cover off, so which is to do with the care in the home. So I just want to be mindful of that with the time. So I didn't want to rush you on this one, but I just want to make sure that, you know, your views on the kind of meetings you're having, and you know, it's not all sing song. It's usually clients who are in quite a vulnerable stage, or maybe it's just clients I see that they're in a vulnerable stage, but yeah, it's quite a vulnerable area of advice, really.
Absolutely. And you can go on to the next page. So yeah, with the case studies, I thought I'd just give 2 examples. And yeah, you know, these are real life case studies, and I think we've mentioned, you know, throughout the presentation, you know, the later life lending gives clients time, and it gives them choice as well. And you know, this scenario was, again, a typical client saying, I think I've got to have a lifetime mortgage. And actually, over the number of meetings I had with him, we actually identified that he didn't need a lifetime mortgage at all. Certainly not at that stage. You know, he was only 66. So just if you can go forward, and because I'm conscious of time, if you can just go on to the next stage. So this client needed to repay an interest only mortgage, and you know, it's really important we have the time with our clients. You know, I have a number of meetings before I even look at recommendations, but he did have some savings. They were needed for future use. He didn't want to be locked into a lifetime mortgage because possibly he was going to move. He still had the income available that he could carry on paying for a mortgage. So sorry, just going on to the next stage. So in this scenario, we agreed, next slide, Adam, sorry, that actually we did a RIO, a retirement interest only, fixed for 5 years, interest rate at 3.1%. You've gone too far.
Sorry, it's a bit of a lag on my side. Sorry about that. I've gone back.
We didn't put a term to it, just to give the client some choice. Although there were early repayment charges on these retirement interest only options, some of them don't apply actually if you go to sell the property, and it met the affordability for both lender and client. So absolutely no reason for a lifetime mortgage for that client. The next one, the next case study, it's a little bit more important, this one, because actually how I met Gloria was through her daughter. She first approached me, was really concerned about mum. They'd seen the money, her savings deplete. You know, there was no way mum wanted to leave the property. It was far too big for her, but there was absolutely no way. Her emotional attachment to the home, there was no way that she was going to leave. And the family just were like, what are we going to do? Again, I met with the children initially, then I met Gloria. She was absolutely fine, you know, from a, she certainly knew what she wanted. It was more physical restrictions than anything else. You know, she did have enough pension income to me living in the home. It was a beautiful property. She took me on a tour, bless her. But yeah, we had then no savings left to be able to continue that, the care. If you can go on to the next slide. So what we look at is option. We always look at what are the alternative options, and I did have a long chat with her, you know, about selling up, and just to make sure that it was what she wanted and it wasn't just the kids wanting her to keep hold of the property. And she absolutely didn't want to go into a care home, and we discounted the interest only mortgage just because, you know, she didn't want to commit to a mortgage, and actually her income didn't quite meet what we needed. So going on to just the next slide, please, Adam. So what we looked at is, okay, so if we could cover your first 2 years of costs so that we knew that exactly what the interest rate was going to be, because when you access a drawdown facility, the interest rate is fixed at the time of you accessing it. It could be more, it could be less. And actually, I do tend to speak to most clients once a year just to check in they're all right and give them an indication if we've seen some increases in rates and whether they want to access the drawdown maybe before we see another rate increase. But we did 75,000. The drawdown facility was there, available at the time. And the early repayment charges applied for the first 10 years, but actually that was a little bit irrelevant because we just knew she was never going to move until it got to a point potentially that she may have to, but she made all those children promise that they were never going to put her in a care home. And that's actually not an unusual scenario, and I'm sure our viewers are seeing this more and more, maybe with their own clients, that yeah, they don't want to, you know, lots of people now want to find a way that they can receive care within the home rather than moving and going into residential. Obviously with dementia and Alzheimer's and everything else, there gets to a point that actually no care within the home potentially, and for the safety of the client and for medical purposes, that there is no, you know, that can no longer be an option. But certainly we've been able to help many clients being able to with their wish as such, to continue the care as long as possible.
And I think this is where, you know, I think just doing what's best for the client and, you know, exhausting these ideas that if we can keep them in their home and that's where they want to be, there are ways to do it. Because I think there was a kind of default position before these products have really, you know, improved over the years, where the house had to be sold and you had to go into a care home. And, you know, I think more and more again with, say, dementia, Alzheimer's, you know, caring for, you know, these clients, you know, if we're able to keep them within their home, you know, they're in an environment which they recognize, they understand, and it could very much help with their care. Whereas obviously going into a care home, suddenly it's a complete new environment, and, you know, it could put them in a more stressful position as well. And I know we've got a number of viewers, and I know one of the viewers on here, we were talking about a client where, you know, their memory, they were still fine, you know, they were still coping. They just needed a bit of a adaptation for them. And one of them was, you know, they'd kind of reverted back to using a kettle which was on a hob, you know, on a gas hob, and they'd kind of forgotten about the new electric kettle. So they were putting the electric kettle on the gas hob, you know. So the easy thing to adapt there was to buy the traditional kettle, you know, so they could put it on the gas hob and it would work as planned to. And, you know, I think these areas really need to be considered, because again, you know, as we all get older, you know, our memory kind of fades, but, you know, knowing where the door keys are kept, knowing where the coats are kept, knowing where the downstairs loo is, you know, it's all those things which allow people to stay comfortable and less stress in their retirement. And obviously we all recognize it comes to a point where care may not be suitable in the home, but at least we can kind of exhaust that idea. And, you know, I know we've had a number of clients where we've looked at care, and care has been very, you know, has been possible to provide in the care home. And also a lot of care products, annuity products, you know, they recognize that they can pay to care services which provide those care facilities in the home, and those annuities can be then switched to pay for care in a care home as well. So I think the whole industry has really moved forward, and I think these types of clients are very vulnerable clients as well, and we need to recognize what they need. And it's not just a chirpy chappy going around knocking on the door going, yeah, no problem, we'll give you one of these products and off you go. It's the much wider holistic approach, you know, bringing people like you into this, Zoe, bringing solicitors in, bringing power of attorneys in, the attorneys to make these decisions, which is best for the clients.
I was just about to mention that. Yeah, it's really important for clients, certainly of an age and what their condition, to be in familiar surroundings. And I had one old gentleman who turned around and said to his son that he was really unhappy that he'd stripped his bedroom wallpaper, and he'd not had that wallpaper in his bedroom for about 35 years. But he was remembering his home when he'd first moved into it, and was quite cross with his son because he thought his wallpaper. But yeah, I do. There's lots of scenarios. So especially if a power of attorney has been activated,
yes,
whether financially or medical, yeah, we very much work together on that basis. And we can set up a lifetime mortgage, certainly if a financial and medical LPA has been activated. And we work with the attorney. So yeah, I should have mentioned that earlier. But absolutely, we've just, you know, it is all about giving the clients the time, their choice, their options, and considering their vulnerable needs. Certainly in that example.
Yeah, no, and I think it's great, and I hope you know, your personality is coming across in this meeting, and I think what you're able to offer, the full spectrum of lending, you know, you can cover all options. So again, when that clients, their attorneys are sat down with you, me, the solicitors, you know, everyone is on the same page. We've covered all the options which are available for that client. Absolutely. And the products now, you know, again, I must put my hand to it. Every now and again, when I mention lifetime mortgages, equity release mortgages, I usually say to clients, look, I'm going to mention this word, you know, it has changed massively, but I'm surprised now, more and more people I'm talking to, they're already aware of these facilities, and you know, it's definitely becoming more of an interest to everyone. So yeah, very useful. I believe, oh, there we go. I was just checking what else was on the slides. There you go. But I believe we've pretty much covered everything, haven't we, Zoe?
Yeah, we have. And just to reiterate, just the last minute, you know, it is very important, and we do take our time with our clients. You know, I tend to have on average 4 meetings with clients or their family. So it's not an area to be rushed, you know, and obviously within the pandemic, you know, there's various ways that we can meet our clients, you know, whether it be face-to-face, Zoom, telephone. So yeah, absolutely. You know, we're here. And I have many clients that I just have an initial call with, and then we'll contact each other, or they'll contact me 2 years down the line. I think my longest one has been 4.5 years. We started the process 4.5 years, and then we finally completed. I think that was last year. Just because of, it was just kept checking in to make sure, things were okay, and everything was set up for when they needed it.
Brilliant. Well, I think we'll bring it to an end there. I believe we've answered all the questions which were coming through, which is superb. We'll pass on your contact details as well, Zoe. I take it you're happy for us to do that. And are you happy for, solicitors and that to give you a call if they have any questions or anything like that?
Absolutely. Yeah, absolutely. Anything that I've not covered today or you need further information, please don't hesitate to contact me.
And there's your alarm to say we've done it. So there you go. Brilliant. Well, I apologize. Don't worry. No, it's perfect timing. Well, I will end the meeting there. Thank you everybody for attending. We'll post the video on, and also before I forget, Anthony's probably thinking I was about to forget it, that we're also there'll be also a survey, a poll to complete when you check out of this meeting. So if you can